Next up, it's my great privilege to welcome our first gold sponsor of the Regional Issues Summit, FNBO. We have a quick video for you, and if we can shift to that real quick. FNBO is a great big small bank with more than 20 branch locations serving Brighton, Boulder, Longmont, Johnstown, Loveland, Greeley, Windsor, Fort Collins, and Wellington communities here in Colorado. They are ranked one of Forbes' best banks in America and the most small business friendly credit card company by Wallet Hub. The FNBO focus has always been community first, and for more than 160 years, FNBO has maintained its commitment to helping to build strong communities as a local bank that understands and embraces its community vision. They're independent and family owned and focused on the long view instead of the next quarter. It's been their recipe for success for generations. We so thank FNBO for your support of the 2021 Regional Issues Summit and for your commitment to Northern Colorado. Next up, it's my great privilege to welcome Kate Watkins. She's the Chief Economist for the Colorado Legislative Council, and she is the legislature's nonpartisan research agency. She leads a team of economists to provide economic, revenue, and caseload forecasts, as well as fiscal policy and equity impact analyses. These analyses are so important and inform the state budget and legislative decision-making in Colorado. She has served as the regional economist of the Denver branch of the Federal Reserve Bank of Kansas City and as a consultant with Bose Allen Hamilton, where she provided economic and business analysis for various federal government agencies. She has a PhD from Cornell University with research concentrations in economic and fiscal sociology, and a Master of Arts in Global Finance, Trade and Economic Integration from the University of Denver Corbel School of International Studies. Kate, thank you so much for joining us this morning, and I'll hand it off to you.
Thank you so much, Sandra. An absolute pleasure to be with all of you today. We'll get some slides up here. Great. So today I'm hoping to give you a feel for what's transpired over the course of the last year and a half of pandemic, recession, and recovery, and what we expect to transfold over the course of the next about 1.5 years. So digging right in here, we can see that the COVID-19 recession was one of the deepest that we've seen, certainly in recent history. So this slide gives you a feel for growth in total U.S. gross domestic product or total economic activity across the U.S. over the course of the last 5 recessions and recoveries. And it gives you a feel for how long it took to get back up to those pre-recessionary levels. So when it came to the COVID recession, the steepest decline followed by the steepest growth that we've seen, and we are now above pre-recessionary levels, above pre-pandemic levels as of a couple of quarters ago, actually. So pretty quick recovery in the grand scheme of things, but certainly quick relative to the Great Recession, which was one of our most prolonged, longest lasting. It took almost 3 years, or actually over 3 years, to get back up to that pre-recessionary level. So this chart gives us a good feel for kind of getting back up to where we were before in terms of aggregate economic activity, but obviously we're still in a pandemic economy. There's still a lot that needs to happen in order to get back up to where we were, or to get back to normal, so to speak. And maybe we won't get back to normal. So in looking at a lot of these indicators, important to note that when we're looking at the headline numbers, yes, they suggest a decent economy, but what's happening on the ground for certain industries is very much different than what's showing here in this graph. So one of the key themes of the pandemic, or the basically key themes of the last year and a half, has been the disparate impacts of this recession and recovery. And you'll see that throughout the slides. One of the other key themes for the past has been the significant amount of federal fiscal stimulus that has helped to prop up economic activity. And that's baked into this chart here, where economic activity is the sum of consumer activity, business investments, net exports, and government spending. So certainly government spending has been part of what's propped up economic growth. And so we'll see what transpires as a lot of that stimulus recedes and wears off in the years ahead. Another way to look at this is from the employment perspective. So here we're seeing the trend similar to the chart before, kind of levels of non-farm employment across the US, across the past 5 recessions. And as you can see with the Great Recession, it took a long time, over 6 years, to get back to pre-recessionary levels of employment. With the COVID recession, we're still not back up to those pre-recessionary levels, and we likely won't be for some time. This is where the COVID recession gets a little bit different, and this is where some of the themes for the next year and a half are coming about, in that we have a labor shortage, and yet we have all of this big gap in jobs where we're just not back up to those pre-pandemic levels, those pre-recessionary levels. So what's going on here? Well, a number of different things. We have a lot of retirements, an acceleration in retirements, some due to health-related concerns, some due to the upward appreciation in asset prices. Home values, the stock market, everything's been quite robust, and a lot of people have decided to either retire early or just decided that they can retire. So to the extent that those folks stay outside of the labor force, some of these jobs aren't coming back. We also have the aging of the population nationally and certainly in Colorado as well, contributing to those factors. The other key theme here with labor shortages would be a lot of people are just deciding not to go back to work, or at least not go back to work the way that they were before. The Great Reconsideration, the Great Resignation, you've heard the headlines. It's all baked into the data here, where a lot of people are deciding not to take on that second job, kind of shifting the way that they want to seek employment. It's a giant change in the game when it comes to the labor market these days. The other factor would be some people just can't go back to work because they have childcare duties, dependent care duties. There's no ability to get back into the workforce the way that they were before, given the pandemic. So you'll see these themes kind of emerging over the course of these slides. So in putting the federal fiscal stimulus into perspective, here we're comparing the COVID recession to the Great Recession, and you can see just how large the fiscal stimulus has been. So the black line shows personal income, sort of our income across all US households. That includes those government stimulus payments. That includes unemployment insurance, paycheck protection program would be kind of incorporated in here to some degree, propping up incomes across households. The blue line pulls out those transfer payments, and so you can see just kind of how bad the drop in incomes might have been, if not for some of those stimulus payments. But certainly during the Great Recession, we had a tremendous amount of fiscal stimulus. The COVID recession, much more than that. And those spikes are the direct payments to households. So as the stimulus is worn off, as unemployment insurance benefits expire, we do expect personal income growth to slow and be relatively flat relative to 2021 levels in the year ahead. So another key theme is that disparate impacts across the economy. And this slide does a good job of encapsulating those disparate impacts. So here you're seeing the change in non-farm employment across high, middle, and low income workers. So high income workers recovered back up to pre-pandemic levels fairly quickly, whereas low income workers are still way below where they were pre-pandemic. So a couple of pieces of the story here would be a lot of part-time workers are not going back to their part-time jobs, or a lot of people who have multiple jobs are not going back to those multiple jobs. So think about maybe a teacher who bartends on the weekends. That's not happening. That's just one example of the types of, kind of anecdotally speaking, the types of workers who are deciding to kind of shift gears and not go back to the way that things were. The other piece here, though, is the unfortunate reality that a lot of low-income households have been really disproportionately impacted by the pandemic. So key trends, when we're looking at those aggregated economic indicators of incomes, of general fund revenue, of economic activity, this isn't showing up in those data because the vast majority of income and a lot of economic activity, as it's currently measured, is attributable to those high-income earners. Another key theme with the disparate impacts is, I mean, it really comes through when you're looking at the kind of industry level data. So here we're seeing the change in non-farm employment across industries. The bar to the far left shows you just how bad job losses were during the depths of the pandemic or during the shutdown in April 2020 relative to pre-pandemic levels. The blue shows you the pre-pandemic relative to the latest data point. So anything to the left in blue is giving you a feel for the ongoing job losses or the gap between where we are now and where we were pre-pandemic. So accommodation and food services still are hardest hit. Frankly, a lot of those jobs probably won't come back, in that a lot of businesses are retooling because a lot of people aren't willing to work those jobs, at least currently. So bars, restaurants, hotels, motels, all baked in there, still contributing the largest portion of that gap. Some other key industries, state and local government, still lagging behind. A lot of industries have come back and are even above pre-pandemic levels, but we have a long way to go. Regionally across the state, certainly some different trends, in particular with Colorado Springs, where Colorado Springs is actually back up to where it was pre-pandemic when it comes to job levels. The rest of the state has a long way to go. And so this chart is showing you the comparison in jobs growth across metropolitan statistical areas and relative to the statewide trend and the national trend. So a couple of other areas to pull out here: Boulder, a bit slow to get back up, in part attributable to sort of the commuter nature of that kind of metropolitan area and the impact of CU and kind of a college town environment, a lot of college students working remotely. Really another sort of laggard there, in that oil and gas has weighed heavily on that region and kind of ripples through the economy in a number of different ways. So really slower to get back up to other levels of job activity relative to other areas in the state. So shifting a little bit away from employment and towards consumer activity, this chart shows you pre-pandemic growth in retail sales levels. So basically what areas of the state are driving consumer activities across the state. And these retail sales data encapsulate not just goods, but also a number of services, including bars and restaurants, hotels, and then other kind of typical services that you might spend money on, such as hairstylists, et cetera. It also includes online sales. So 2019 levels, consistent with what we've been seeing over the course of the last nearly decade, where it's all largely driven by I-25 corridor, a lot of activity in northern Colorado, certainly. During the recession, or at least during 2020 as a whole, we did see some drags in northern Colorado, in part attributable, again, to kind of weakness in oil and gas activity, in part attributable to the commuter nature of some of our metro areas, including sort of Denver, Adams County, Boulder, also attributable to people changing their lifestyles over the course of the pandemic, maybe moving outside of the city, spending their dollars elsewhere. We certainly saw those trends come through. And again, you're seeing some of the strength in Colorado Springs in spite of the pandemic. Moving into 2021, the current year, at least year to date, we've seen a reversion back to those pre-pandemic trends. So growth along the I-25 corridor, and also a lot of growth in our mountain resort areas, people shifting their consumer activity to kind of places that they want to work, more scenic areas of the state. Do want to highlight inflation, or at least touch on inflation, in that I know it's top of mind. It's certainly consumed the headlines lately. And this really gets to that second set of themes: the labor shortages, the supply chain disruptions contributing to increased inflation. And so do want to kind of dive in here, dig a little bit deeper than maybe what you usually get. So here we're seeing the US city average of CPIU inflation. This is the inflation indicator that you see reported most in the headlines. And certainly it's elevated relative, at least to the past decade and a half. And looking at a longer trend, it is elevated, though nothing quite like what we saw in the late 80s. But it's high. It's much higher than we've seen in recent history. We do think a lot of the components are transitory, are attributable in particular to supply chain disruptions. And you can see that as you dig into the components shown there on the right. In particular, the transportation component. Now, to break this down a little bit, the headline number is the kind of the full basket of goods. So it's all of these components combined. Core takes out energy and food, the food components. Those are the most volatile. Still seeing some decent inflationary pressures there. And what's under the hood there is in large part the transportation component really driving inflationary pressures. And in particular, it's the cost of buying a car. So because of supply chain disruptions and the nature of the pandemic, we have a shortage of vehicles and a lot of demand for new cars, given that people have stimulus checks. The economy has actually performed pretty well for a lot of households. So people want their new cars, they can't get it, and it's really driving up these inflationary prices. So we do expect some of these inflationary pressures to dissipate once those supply chains get sorted out. Now, transportation or auto sales, that's not the only piece of the supply chain disruption puzzle. What we've been hearing through surveys of businesses is that supply chain disruptions are affecting almost all businesses in some capacity. On top of that, we have labor shortages, which is driving up wages, all of this contributing to upward pressure on prices. So we do expect inflationary pressures to remain higher than what we have seen in recent history. We think that they'll likely be the highest in the current year, in 2021, and then dissipate some in future years as supply chain constraints kind of get worked out through the pandemic, but there's still ongoing upside risk to inflationary pressures. Looking at Colorado specifically, and this is again digging in even a little bit deeper into inflation, on the left, you can see the weights across these components. So the major components of inflation, housing by far represents the most. It's more than 44% of the basket of goods when it comes to the CPI index. Transportation, also a decent chunk there in that when you buy a car, it's probably the biggest purchase that you're going to make. And that's, again, kind of turning to the right side of this chart, looking at the inflationary pressures, the transportation component is where the vast majority of that is. And when you multiply that 14% weight by that sizable double-digit inflationary pressure, that's what we're seeing driving up inflation, at least currently. Definitely some other inflationary pressures going on in Colorado, in particular apparel, though because it's a much smaller share of the basket of goods, not contributing as much. Looking at the trend in these kind of the headline index and then some of the major components, again, transportation, the biggest piece of the story there. Though housing costs is an important one in that this is likely going to be behind the story between kind of Colorado versus the nation. And comparing the two, Colorado's inflationary pressures are actually lower than the nation in that our housing component isn't showing as much drive as what we're seeing across the nation. A lot of that has to do with some of the idiosyncrasies of the way that the CPI index is calculated. Some of it also has to do with we've had really strong home price appreciation and rental price appreciation for almost a decade. So we're coming off of this high in some ways, whereas the rest of the nation, it hasn't been as strong. And so we're seeing more rapid inflationary pressures when it comes to the housing component elsewhere. Talking more about housing, we have seen home price appreciation, certainly in the state of Colorado and frankly across all areas of the state. It's accelerated during the pandemic. Certainly a lot of demand, a lot of people wanting to either move into or invest in homes in Colorado, and that's really driven up home prices over the course of the last several quarters. We do expect this to level off some, in part because some of the pandemic-related frenzy, if I may, we do expect that to dissipate. And a lot of people are just walking away from these super high home prices because they can't afford it, because interest rates sounds like they're going to be going up soon. So a lot of this is cooling the market a little bit, or at least cooling it at high levels. So we do expect some leveling off in home prices. So I won't belabor the summary, but I do just want to kind of reiterate those key themes where historically, the themes have been, or at least over the course of the year and a half, it's been significant federal fiscal stimulus and also disparate impacts of the pandemic across households, across businesses. Moving forward, we think supply chain disruptions and labor shortages will be kind of the key themes over the course of the next at least 1.5 years. And I did want to touch briefly on just what's going on with state general fund revenues, in that there's sort of a microcosm of what's going on in Colorado's economy and the national economy. The two biggest sources of state general fund revenue, which is our most flexible source of funding in the state, are income taxes and sales taxes. And here you can see that relative to the Great Recession, where we saw decreases in both have been quite resilient and remarkably resilient in many ways during the course of the pandemic recession and recovery. So individual income taxes actually accelerated during the course of the pandemic. Sales tax collections, we definitely saw some disruptions due to the pandemic, but we're way back up above pre-pandemic levels on some of that stimulus, also on the strength of a lot of incomes across households. So whereas we were expecting, during the depths of the pandemic, we were expecting sizable declines in general fund revenue relative, that kind of consistent with what we saw during the Great Recession and the 2000s recession, what we actually saw is something much better. So ongoing growth throughout the course of the pandemic when it comes to our general fund revenue, and we do expect that growth to continue over the course of the next couple of years. So as we forecast to kind of a recession, the typical recessionary impact of a recession, the end revenue came in much higher. But the end result has been sizable reserves, or sizable kind of rainy day fund, so to speak, that's accumulated. So lots of money left over because the General Assembly budgeted for a recessionary situation that did not actually transpire. So the state finds itself in a pretty good fiscal situation moving forward. And so I want to provide a little bit of context about what that looks like. So because we had stronger revenue growth, we now find ourselves in a situation where we're exceeding the Tabor limit, or exceeding the referendum C cap. So in Colorado, we have the Tabor limit and the Tabor amendment, which is unique to our state. And one of the provisions that Tabor has is a limitation on the amount of revenue that the state can retain and spend. Most of that revenue is general fund revenue. So the chart that I just showed you, some of that revenue is also cash fund revenue, but the vast majority is general fund revenue. Anything that exceeds the referendum C cap is returned to taxpayers. So we get taxpayer refunds when revenue exceeds the referendum C cap. What that means for the state budget is that general fund revenue is limited to the amount that falls under that referendum C cap. So this referendum C cap is essentially, or the Tabor limit is essentially putting a cap on the amount of revenue that the state can retain and spend. And so it will be the limit on how much general fund revenue is available moving forward. So pulling all of these pieces together, this last slide gives you a feel for the amount of spending, the amount of saving left over, and the budget situation that the General Assembly is facing in the year ahead, FY 22-23. So to kind of walk you through this a little bit, the light gray on the very bottom, that's general fund appropriations, or the amount of kind of allocated spending across departments. Transfers go to other programs elsewhere, other cash funds. In other words, so sort of your spending is the gray on the bottom, and you can see the recessionary levels of spending that were budgeted for between FY 1920 and 2021. Revenues came in much higher than expected, and that's where you see that big excess in savings, that excess reserve on top of the statutorily required reserve. So in blue, those are your savings left over at the end of the year. And you've seen those accumulate to a much larger extent than what we've seen in the state's history. So really sizable money left over that hasn't been fully spent, at least in the current year. It hasn't been fully budgeted for. And so we still have this excess reserve, excess kind of rainy day fund, but it's one-time money. So if we do spend it all in the current fiscal year, 2021, then it's not available in subsequent years. So in looking forward to next year and the years ahead, that yellow bar kind of gives you a feel for how much additional money the General Assembly has to work with. But again, it's one-time money. It's the money that's left over based on all of the budgetary decisions that have been made over the course of the last 2 years. So if it's all spent, it's not going to be replenished in future years and could result in a cliff effect in the future. Couple that with the limitations of revenue because of the Tabor limit, And what we're facing is a situation where revenue can grow by inflation plus population growth, but otherwise you just have this one-time source of money. So inflation plus population is looking at about like 3 to 4% per year in growth. So that would be your kind of capped revenue growth. Otherwise, the state legislature doesn't have any ability to grow the budget beyond this, absorbing this $3.3 billion in one-time money. So this doesn't account for the stimulus dollars that are kind of outside of the general fund budget. So that's another factor to kind of think about when thinking about the budget situation ahead. But the bottom line is that the state finds itself in a pretty darn good budget situation, and one, especially given the recession. So lots of savings that could be tapped into, but one-time savings, and so strategically allocating these, spending them either over time or all at once in kind of a stimulatory manner those are the budgetary decisions that the state General Assembly, is facing. I'll conclude there, but again, thank you so much for having me, and please feel free to reach out if you have questions and you don't have time for those questions.